Ladies and gentlemen, good morning, dear friends, good morning to you. I'm a little bit worried about your patience, a longish patience to sustain quite longish presentations. So I shall be very brief in order not to exhaust you. What's going to help me in this process is that I'm in agreement with what has been said by Christian, which is going to delete at least half of my presentation, what I intended to say. He said it very well and nicely, and so he went into the nitty-gritty of things very speedily, and so I'm entirely in agreement with Henry, and I shall be quite brief. I'd like to invite you to take coffee. So, there is need to whet your appetite for coffee, and so I'd like to thank I would like to thank the organizing committee for having invited me for the third time. I'd like to talk about the funding and financing in Africa. I respond, yes. Africa, can it fund its own development? Yes. What's important in Africa is from Tunisia to Malta, and from Malta to Rabat. This is becoming true and a reality on the ground, and so these are things that are becoming quite important. And so Jeffrey Sachs' picture was shown to us, and so an optimist, I think, Afro-optimism, and so Afro-optimism is gaining more ground in the field, and even with regard to public aid. As has been said by Christian, and rightly said, how can we transform savings in order to build and to grow and prosper? So taking savings need to be made available and need to be made. We need to mobilize these savings in the last 10 to 15 years to really to build the housing and to rehabilitate the housing sectors, or in the 50 years if we're building dams. So finance is becoming quite a dangerous business, and so in the developed world, and so in the last 5 years, and so having savings that are available that we want to use for the next coming 50 years, and there is need for readjustments, and so at least people are saying that they require liquidities, and we have had problems with liquidities, and so when the crisis of 2008 has really made things more difficult. And so in Africa we have savings available because we don't have sophisticated financial instruments available in Africa, and we have really long-term use of these savings, and so unfortunately we need to fund long-term projects. So in all economic activities, those that has the important coefficient is the agricultural sector, and so in the agricultural sector we need to continue to export raw materials of an agricultural nature in order to meet the needs of the industry, such as cotton, and so we also need to feed a growing population in Africa, and so we have needs that can be measured and gauged on the basis of the fact that the population will double in numbers within a generation, and this is in addition to the fact that the population is going to grow, it's going to double its purchasing power within a generation, and so we will have quite a lot of demands by this growing population, nutritional demands, quantitatively and qualitatively, that is quite considerable and substantial. This is something that this is unprecedented, because it's very quick, at least in terms of demographic growth, more important than in China, in India. It has no comparison with the Industrial Revolution in Europe, 1% of growth of the GDP. So we are operating along the lines of unprecedented experiments, and so considerable development is required. But from the point of view of funding, there is a requirement, is that it is unfortunately it is the most intensive, labor-intensive, capital-intensive activity in order to make a kilo of cotton, or to manufacture and to produce 1 kilo of milk, you need to spend twice the price of this milk. To have a turnover of 100, you need to have a turnover of 200. When you are in the processing industry, such as to reach $100 of turnover, then you have to work for. You have to have a turnover of 500, and so unfortunately the time to have a return on capital is longish, and this was quite rightly said by Robert yesterday. You need to improve storage facilities, and the problem is not agricultural. Due to agricultural mechanization, you can be successful in discharging your duties along the Algerian way or on the Guinean way, but then there is an environment that is made up of infrastructure that needs to be promoted. And what comes after agriculture, basic infrastructure, it comes as a second capital-intensive sector, and the energy sector. What is the less manufacturing industry is the least intensive in form of capital. The least intensive are also the service sector. Unfortunately, what remains to be done is truly to reverse the trend. The more it is capital intensive, then the more longer time is needed, then this corresponds to Africa, and so we have a problem. We have a problem with the unavailability of the relevant experience in Africa. So there is a revolution. There is a revolution taking place, and we've talked about this in recent conferences. It is accepted. When we said this, when we said 10 years ago, then probably we were perhaps considered the laughing stock, more particularly, and 10 years ago it was considered ridicule. But what Christian said, what was not available 10 years ago, now it becomes a reality. So foreign direct investment is a reality, are more and more Africanized, and so when we talk about African investments in Africa, we talk about Morocco, contributions, South Africa, Nigeria, Egypt. We speak essentially about Morocco and South Africa as capital investors. And so the diaspora, the role of the diaspora is more important than public aid for development. So I'm saying I'm very favorable for more public aid to development, but there is also the remittances of the diaspora that really, which were 20 years ago amounted to zero, including the European diaspora in Africa that exported its own shares. If you look at the shares of savings, they were very negative at least 20 years ago for Africa. Today, we have a reverse trends in terms of remittances by the diaspora, 40 billion or 60 billion US dollars. With regard to the figures that have been put forth by Henry, this is quite an important segment compared to public aid to development and also to direct flow, direct investment. And so the diaspora plays a fundamental role, and Morocco, once again, is an example to emulate, more particularly in terms of diaspora remittances. So 60% of the GDP, and this is Cape Verde. 60% of the GDP of Cape Verde is made up of remittances of the diaspora. And so there is Sudan, Nigeria. The most important percentage of the GDP are Morocco, Senegal. This is a general phenomena that is quite important to take on board. Africa is funding itself the basis of remittances put forth by and sent by the remittance by the diaspora. And this is quite important. This is becoming the same mechanics that is quite powerful in Africa, at least. Public aid on reducing the debts. I'd like to mention that in addition to the reduction of the debt indebtedness as a mechanism, this is the best invention. The best invention has the immense advantage that has no cost incurred by the operation. So when you have 1 billion of indebtedness, you are not going to spend 400 millions to run and manage the indebtedness, and this is instantaneous. In general, it has conditionalities that are positive, and it has no cost to be paid, and no bureaucratic intervention is needed. And it's extremely difficult to engage in money embezzlement, more particularly when you are dealing with the reduction of indebtedness. This indebtedness is quite important. And I'd like to add that in the financial revolution that we have seen, that all the financial flows have become quite positive. Africa receives all the fundings that are necessary in all forms, but first and foremost in private flows. The bankerization has increased and will continue to progress at rating the banking accounts rates and opening of these banking accounts, bancarisation. So the French president was saying the African who did not inch into history, and in a Dakar address that was deleted by another speech. We did not inch into history, but we are speeding up this inching in, because the bankerization has really seen the development of microloans. Microloans have multiplied because microloans and developing trusts and trust this doubles the effect of opening bank accounts. Bank accounts have increased by leaps and bounds, and so in South Africa, the rate of bank accounts is quite important. Take West Africa and also Central Africa. You have a rate of bank accounts amounting to 12%. 12 inhabitants out of 100 have a bank account open, and you have a rate of trust through microloans that is almost equivalent, and so 1/4 of the population has bank accounts open, and so that is we're going to do same thing as the pace that was adopted by Central European countries did. So there is a word that is the word that has not been pronounced. It's the colonization. Colonization did not last long. In my country, the decree of 1845, colonization came to. Colonization ended in 1960 in my country, and so we have had as a legacy the most archaic financial system, that we were below during independence. We were below in terms of sophistication. We were below expectation of the way things operated. Things operated like in Greek history or Greek times, and so we funded campaign loans to. So we got the legacy from British colonialism and Belgian colonialism, and unfortunately Morocco was not a colony; it was a protectorate. In Benin. We inherited the most archaic financial system on earth, and so we have very few bond markets, mortgage bank. This country is an exception. You can see buildings that are built here in Rabat because there is a mortgage market available. There is no such market available in sub-Saharan really building a house. This means buying a sack of cement on a daily basis until you build. It's not the bank that's going to provide you with a loan so that you can help. Things are not faring nicely in Cameroon, Senegal, but there is no mortgage market available in this sub-Saharan. We are capable to find. We are able to fund the informal sector, and nobody. So there is no competition at. We have been given a system that consists in collecting deposits and to fund the campaign of cotton campaign to harvest cotton or to have groundnuts and also coconuts and with a rotation that is extraordinarily swift. Unfortunately, a number of European banks have stayed within this archaic model. So the consequence, let's take the French area. We were in the French franc area 10 years ago, and so it has reached 16%. The market share in the French franc is equal to the share of French banks that are followed by Nigerian banks. The first bank in Mali is called BMC, and the first bank in Senegal is called Attijari Wafa Bank, which is Moroccan. And so in Benin we have BMC, which is the Moroccan banks are on an equal footing, playing on an equal footing with European banks. From mortgage market, mortgage loans, investments. Moroccan and Nigerian banks are involved. United Bank of Africa, Nigeria, which is capable to fund the major risks. The more the European banks they are removing their activity from a number of markets. Why? Because they don't have the right, because of the implementation of Basel standards. They are not allowed to take risks. So mortgage.
Tout à fait les mêmes sujets de réglementation, notamment à travers l'épargne. C'est un peu technique, mais un tout petit peu plus de latitude que d'autres.
There are latitudes that are quite different. A French bank can no longer fund a nucleus unit in Morocco. A French bank will not participate in funding a high-speed train in Morocco or in Kenya. Let's be clear. It's not possible, taking into account the Basel's standards on Basel's requirements. And so when the CFAO was sold, by the French group PPR, CFAO is the first distributor in Africa of cars, and also distributor of technology. When the CFAO was sold to Toyota 1 year ago, there was an attempt to engage in capital investment. That is to say, this is a business I'm discharging myself. We put equity and seed capital, and we buy CFAO, and so 8 years later we sell it in the stock exchange. CFAO has cost 3 billion euros, and there was need for 1 billion euro of debt. So there is no European bank that's capable to mobilize the 1 billion. They resorted to a British fund involving Singapore, also the South African Pennymer. So they put quite a lot of capital on the table. The only banks that put forth who are able to fund this are the South African banks. And so we cannot take long-term risks. Only banks that are no longer Europeans, banks that are from emerging countries, and also African banks, but for issues pertaining to time, there are only two bank systems, that is South Africa and to a certain extent Morocco. And this is a new reality on ground as in financial terms. So we are undergoing financial revolution, but the most important concept that I would like to highlight here is endogenous concept. What is interesting in this regard is that we are starting to look at Africa for what it is, nothing different from other continents in the world. The growth all over the world is done in an endogenous manner, capitalizing on national labor and also on savings, and also capitalizing on national know-how. Exports, however, is seeing Africa from the export side is an error, a considerable error. It is a European error more particularly. It's an error which is no longer North American, and which is not Asian or Latin American. Africa is not an international topic or an international a continent that lives on exports and from export on the exports. We are not a continent for exports, and so the problem of funding are not the problems of a continent that will export cotton mainly, coffee, groundnut, or as Christian was saying, not exporting high oils. Exports from Africa represent 25% of the GDP. Africa is not a primary economy, it's a tertiary economy. It's a tertiary economy, however. So the fact that we have some Emirates really producing oil does not lead us to hide the forest. And so it's not Africa is not a primary continent. Agriculture, however, is less productive, although it feeds quite an important part of the population, and it contributes less to the GDP. Africa needs not be seen through through European eyes. Africa does not resemble its portrait, the portrait that is portrayed by a European. Africa is not in Dunkirk, or Africa is in Rabat, in Cotonou, made up of people who are really working on a daily basis. Forget about exports, forget about hydrocarbon exports. Africa is a strategic part and share of exports, but this is not what makes the daily lives of everyone. The daily lives are made up of daily consumption, building one's own home, and this is what needs to be financed and funded. There are countries that fund and finance in a whole way their needs in order to create employment. South Africa is part of these countries in an indigenous manner. It has the instruments that will transform this important savings. 21% is the figure. This is quite high. It's quite high than the rate of savings elsewhere, and it's more important than the one existing in Europe or in Japan. So it's also 21% of the savings is a miracle. 400 million people who still live with $1 on a daily basis, and you can tell them that they need to make savings of this $1. This is quite an important miracle in Africa. The more you are dealing with vulnerable populations, the more they resort to savings. And then the more you are dealing with businesses that have no bank account, we are an exceptional continent that you resort to self-financing. So it's the most profitable continent in the world because the labor cost is very low and the levy rate, compulsory levy rate is below 25%. We're operating at the 25% of obligatory or compulsory levy rate. But Africa is half of this. So when you don't have levies and when you have labor costs that are very low, is that you have the highest profitability rate in the world. And this is not seen through this spectrum. Why are you forced to have margins of profits that are quite high? Because you have no other means than self-funding. So because the formal sector operating within formal or informal sector, you will not be. You will not receive the appropriate funding unless you have, and you are an important entity.
On estime qu'il a 77%
there are 77% within national hands in terms of savings. It has 77% of these funds, and Moroccan expatriates contribute immensely. So this country Morocco is funded by the Moroccan expatriates and by the nationals. My country, Benin, we are funded at a level of 22%, and this is quite characteristic. This is a characteristic feature of sub-Saharan African countries that have been able to develop all the instruments in history, or they haven't dismantled these mechanisms. We fund at 22%. So whatever we do, we need to have external resources. The innovation is that there are banks operating, non-European banks that are changing the reality on the ground in our country. That China, India, in East Africa, then they are active in these banks, and so the China has quite an important shareholder, is an important shareholder in Nigerian banks and also in South Africa. So little by little, emerging countries are gaining ground, and there is the role to be played by institutions on a long-term basis that are discharging duties that the banks no longer want to do, and so taking risks, risk-taking for 20, 30 years to fund energy sectors, water sectors, or transportation sectors, agriculture. These financial instruments are beginning to emerge in Francophone countries, more particularly. I don't know why the radiation of GD, the deposit bank is quite Francophone. In the Anglophone countries, there is something that is quite important, are the pension-based funds, pension funds. In Anglophone countries, there are 500 billion US dollars in the form of assets available from pension funds or business pension fund. This is quite an important revolution. When we have 1,200,000 million of GDP, and you have 500 billion in your, and you are the youngest population in the world, you are going to do what Singapore has been able to do. You are going to use, the younger generation, and you have the immense advantage to have more active young people and very few pensions to pay, despite what the French think. This is the moment. This is not the moment to engage in social protection. So you have quite a number of, so you have the impression that it's an important, it's an important burden, and this is what the So there are pension funds because you are going to accumulate resources that are resources pertaining to commitments spanning over 20, 30 years. And rather than going to the World Bank for money, one day they will not go astray to fund your basic infrastructure. When you ask the World Bank, when they accept, when the World Bank, when the bank really accepts to do it over 20, 30 years with resources that are imported from pension funds, you can do it in other countries with the inputs of other banks that have money available, because the figures that have been provided us by Christian economic commercial surpluses. We are the only continent that has a commercial surplus with China. When you have a surplus of $60 billion per year, what do you fill? You fill your fund, your exchange funds. So you have a double surplus. Africa has moved from a double deficit to a double surplus globally, and so it has $500 billion US dollars available, and this is quite important for long-term development. So we have sources of funding. I tried, so we had so the World Bank is quite useful, although I've tried to depict the World Bank under the blackest perceptions. The telecom sector, I've worked in privatization sector, and thanks to the World Bank, there was the funding of privatization, though then the World Bank was not completely absent from the telecom sector, and the telecom, it's a success story that proves that the World Bank has made predictions, more particularly with regard to the number of subscribers. 500 million subscribers were slated to be subscribers in 2012. So this is a phenomenon that has not been seen by the private sector or by the it has not been funded by the private sector, and so this is a niche that is quite important, but it has the comparative advantage that it self-finances itself. It was quite higher than what was expected initially, but it is, and so you have the payback of 2, 3, 5 years on heavy type of infrastructure. And here, the bank have been able to fund and finance the telecom operators because either they were foreign to Africa, or they were leaders in Africa, such as Vodacom, Celtel, or because from North African countries, North and South, really, that can fund this type of activities. And so Sub-Saharan Africa found itself indirectly funded and financed. Today, the World Bank has a portfolio targeting the telecom amounting to $2 billion US dollars. $2 billion is the half of the stock exchange available in Senegal, and this is a fraction that is very low of the Meditel company and Maroc Telecom in this country. The private sector is capable, under some conditions that are being achievable. We have to have long-term funding sources. We have to have financial operators, and so we are beginning to have them. We have to have institutions of deposit banks or sovereign funds that are emerging, and so we're starting to have these operators. And thanks to the telecom, we have the proof that we can create employment, unskilled and skilled employment. We can generate positive externalities in the whole of the production system. We can jump ahead a whole generation, but we need to multiply agricultural applications, which is formidable for the private sector. The World Bank has spent $250,000 in Kenya for applications and at least payment for the engineers who are behind the design of these applications. The economies that are generated for the last 5 years with regard to agricultural applications in Kenya, for Kenyan operators, there are units of accounts are billions and billions of dollars. And so telecom, this is something that is crucial, because this proves that the multilateral system can go astray and go. Multilateral system cannot be necessary, and that is profoundly contingent upon some other criteria. That public aid for development is not also the only way to develop, but we need to mobilize other resources, and we need to admit all this miracle is quite possible and within our reach if we have available some institutions, some financial resources, and if we really if we are solvent. So what needs to be the law for underpinning aid for public development is to take care of those countries that are not solvent. So we need to make computations, and so we don't need we don't need funding of financing of toll highways, and the ports and airports. Look at the Dakar airport. This can be in the form of PPPs, but with economic computation and an economic logic that is quite simple. What we need is positive externalities for the agricultural sector, and we need the rural electrification. We need these things that are completely necessary and that are really absolutely not solvent in stages 1, and I think the multilateral system need to say there are things that I haven't been able to do, that I have missed. So this is a level, this is a criticism leveled against the World Bank, and so there is need to speak the language of truth. In the history of the World Bank, there are very precious moments to tell the truth, and so this gentleman was saying we went astray in connection with the agricultural sector. We funded the revolution in Mexico, in India, and we funded the revolution in China, and so we stopped we stopped funding agriculture in Africa. The World Bank can go astray, but it's fundamental that it can play a role. Nobody else is able to play this role. So 85% of the funding will be covered by the private sector, national private sector in Africa, with this transformation of 21% of the GDP. 21% of the GDP is quite sufficient to develop a whole continent. 21% of GDP amounts to $230 billion per year. This is quite sufficient, and this is the savings by the households, by the businesses, by the state. It's quite sufficient in Africa. What was lacking was to turn these savings into something active, to generate income. So you have $140 billion in the Central Bank of Algeria, half of it in the American bond treasury, and some of it is in Libya. So these monies can remain idle, and they are becoming quite active. And therefore, there is no macro problem of funding and financing, because this is true in Morocco, but not in Benin. Benin needs to catch up, at least needs 10 years to catch up with Morocco, but it's not true. But all this is changing. Money that is idle is becoming quite active, thanks to the work of the private as well as public institutions. As to the system of public aid for development, development, then we need to accept to look at the fact what we did in infrastructure is criminal. What I did in the agricultural sector is irresponsible. In the telecom sector is nil. I have done nothing. I have seen the only miracle of Africa coming to the fore, and I didn't understand how this miracle was made available. We don't need you. We don't need you at all, because we need you elsewhere. We need you everywhere where we are not able to properly do things nicely in the fields. We have macro problems in Africa in terms of resources. We have also problems in instrumentation. As long as we don't know, as long as we don't put in place long-term financing, and as long as we don't grapple, I don't know how to grapple with problems of energy and water. We have gone out of the zero growth pattern, and we need not continue to give lessons to Africa, at least. So there are still many people that are giving lessons on growth for Africa. But let's forget for a moment this detail. 5% is not sufficient enough in terms of growth rate. 5% of growth rate, we reduce poverty, we commit a fundamental transformation of the economy, and when you see the evolution of middle classes in Africa, the changes in consumption, changes in education, the nutritional feed, the health indicators changing. My country, which is the 175 in human development, the transformation is done on a daily basis, and so we can fund, we can know how to fund. We don't know how to fund poverty reduction. It's not the statistics, and so it's not people from middle classes who have just emerged in the statistics of incomes. It's these people who are more educated and who are poorer, because demographic growth is a considerable asset, but it is also creates a fundamental constraint. Once again, in my country, Benin, and I think you have said this, and it's quite important to keep in mind, we were less than 3 million inhabitants at independence. We are more than 10 today. So the two-thirds of the population lived below poverty threshold during the colonization period. There were no considerable performances of the country in terms of reducing poverty in Benin. There's 2 million poors. Today, there are less poor. It's not the two-thirds of the population that are living below the threshold poverty. It's one-third. Two-thirds of the population can have access to potable water, to education, and this makes a considerable transformation. The small-scale problem is that one-third in the 10 million makes 3 million of excluded and 3 million of poor people. And so the Chinese equation, whereby we say if Chinese growth should decrease from 8 to 4%, the social pact will be broken, and we will not be able to resolve the problems from which Chinese farmers suffer. And so the same thing applies for Benin. And so we will be able to solve quite a number of ways, create infrastructure. We are capable to have under control some of the consequences accruing from climate change, but we will not be able to reduce the number of marginalized people. We will increase it. And so when we are not elected on the basis of statistics, but we are elected by communities. And so when you go, when these people who are elected needs to be trained, and we have a trained youth, more trained, but excluded and marginalized, and this requires a funding and financial effort in order to increase growth higher than the Tunisian level, which amounted to 7% of growth. There is need for boosting inclusive growth that presupposes that will derive and learn all the lessons on what's working and not working. The growth of, we know perfectly we can increase the growth rate. 5% of growth rate is not going to resolve the problem of poverty. It's not sufficient enough. So the problems of poverty remain completely valid as long as we don't know how to finance. To finance this, in order to be, we need to be capable to finance on a long-term basis. And this is the missing link in sub-Saharan Africa. Although providing nourishment for the whole planet using survival crops. This is an extrapolation of an extremely vulnerable situation, and this is not the reality of Cameroon or Cote d'Ivoire or Kenya or Rwanda, which are they are multifaceted farmers, and so they can be fruit growers, they can be crop farmers, and so we're not as vulnerable as one might think. Robert was talking about the misery in the countryside, working on survival crop. No, absolutely not. People are really people go to the cities because this is the result of technical progress, and so if it would be better to have people alive and well in slums rather than in the desert, and so there is need to find appropriate measures and efficient measures. Growth does not attract the people who come to the cities, and the peri-urban suburbs are people who are very audacious, better trained. It's not the migration due to poverty, and this trend. It's not the brain drain. Those who are miserable, we don't know how to reach them, and then as long as we don't have a strong growth, then we will not know how to reach those people who are marginalized. But we need to capitalize on long-term funding, through microloans, through micro-private equity, and there is no need to be involved in multi-billion projects. The microloans then can contribute to reduce poverty, and this is an answer. So perhaps can Africa fund its own development? Can Africa work towards really eradicating poverty? For the time being, it's not possible to say yes.